In 1972, some of the smartest investors on Wall Street put their entire life savings into 50 of the most profitable companies in America. 2 years later, they lost everything. These weren't gamblers. They weren't reckless. They were experts. And that's exactly why they failed. The US economy is booming. And on Wall Street, a belief takes hold. A belief so powerful it spreads through hedge funds, pension managers, and elite investors like wildfire. The idea was simple. There are 50 companies so dominant, so unstoppable, that you could never lose money buying them. Companies like Xerox, Polaroid, Kodak, McDonald's. They called them the Nifty 50. These weren't penny stocks. These were the blue chips, the sure things. And the people buying them weren't amateurs, they were the most sophisticated investors in the world. But here's what happened. By 1974, the Nifty 50 had collapsed. Some stocks lost 80%, 90% of their value. Polaroid went from $149 a share to $14. Xerox cut in half. So how does a room full of financial geniuses make that mistake? The answer isn't stupidity, it's psychology. Here's what the research actually shows. In 1979, two psychologists, Daniel Kahneman and Amos Tversky, published a paper that would eventually win a Nobel Prize. They called it prospect theory. And it revealed something uncomfortable about the human brain. We don't evaluate money rationally. We evaluate it emotionally. Specifically, the pain of losing $100 feels roughly twice as powerful as the pleasure of gaining $100. Think about that. Your brain is biologically wired to feel losses more than wins. And here's the trap. The smarter you are, the better you are at building arguments to justify your emotional decisions. The Nifty 50 investors didn't ignore the warning signs. They rationalized past them. They told themselves a story. These companies are too big to fail, and their intelligence helped them construct an eminence airtight case for staying in. Psychologists call this motivated reasoning. It's when your brain works harder to protect a belief you already have, rather than find the truth. And here's the brutal part. Higher IQ doesn't protect you from it. In some studies, it actually increases the effect. But motivated reasoning is just one trap. There are two more, and the second one is the one most people never see coming. Trap number 2. The Dunning-Kruger inversion. Most people have heard of the Dunning-Kruger effect, the idea that people who know very little tend to be overconfident. But there's a flip side almost nobody talks about. As you get smarter, as you learn more about finance, investing, markets, you start to see every angle, every possibility, every risk, and that awareness can paralyze you. It's called analysis paralysis, and it's devastatingly common among high achievers. The investor who reads 10 books on real estate never buys a property because they've identified 47 reasons it could go wrong. The person who studies the stock market for 3 years keeps their savings in a 0.1% savings account because they can't decide which fund is perfect. Knowledge, without a framework for action, becomes its own kind of trap. Trap number 3. Social proof at scale. One reason the Nifty 50 bubble grew so large was because everyone around these investors was doing the same thing. Psychologists call this herding behavior, and it gets stronger the more educated the group is. Why? Because in elite circles, people assume everyone around them has done their homework. If Harvard-educated fund managers are buying Polaroid, it must be a good bet, right? The problem is, when everyone in a room is looking at everyone else for confirmation, nobody's actually looking at the data. Let me give you 3 scenarios from right now. Scenario 1. You see a stock going viral on Reddit or TikTok. Everyone's talking about it. Your gut says buy. That's herding behavior, and your intelligence is rationalizing it in real time. Scenario 2. You've been meaning to start investing for 2 years, but you keep researching just a little more. That's analysis paralysis wearing the costume of responsibility. Scenario 3. You hold on to a losing investment way too long because selling it means admitting you were wrong. That's loss aversion and motivated reasoning working together. 3 traps, 3 scenarios, 3 ways a smart person makes a dumb money decision not despite their intelligence, but because of it. So, what's the fix? The research points to one consistent answer: pre-commitment rules. Before you invest anything, write down 3 things: why you're buying it, what price you'll sell at if it drops, and what price signals success. Then, and this is the hard part, you follow those rules even when your brain screams at you not to. Warren Buffett has said he writes down his investment thesis before he buys, not to remember it, to hold himself accountable to it later when emotion kicks in. You don't beat your psychology by being smarter. You beat it by designing systems that make the smart decision the automatic one. The Nifty 50 investors weren't foolish. They were human. And so are you. If this shifted how you think about money even a little, hit subscribe. Because next week we're going into something even more uncomfortable. Why the advice you got from your parents about money might actually be keeping you broke. I'll see you there.